You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Professor Michael Salemi, who is a professor of economics, having spent most of his career at the University of North Carolina. Mike, a pleasure to have you.
Thank you, Doug. It's great to be with you.
So you focus on domestic and international monetary theory as well as economic education. In fact, you're known as one of the top economic educators in the country. What got you into economic education?
Well, I've always been interested in how students learn, and my job as a graduate student at the University of Minnesota, where I completed my PhD work, was running a little training program for the other graduate students who taught the undergraduate courses there. And when I got to the University of North Carolina, we had graduate students, and they taught, and so I helped start a program there, and it kind of was my springboard for more and more work in that area.
So you're a born teacher, but one of the things you talk about is on the banking system and the fundamentals of the money system. For the average person, is this something important for them to know, or can they just know that they go into their bank and that's where they get their mortgages and keep their savings?
I do think that the average person would really benefit from knowing a little bit more about what banks are and how the financial system works than the minimum amount they need to just run their own accounts. Let me give you an example. Pretty much the cry during the Great Contraction was Wall Street versus Main Street. Mm-hmm. And I think anyone who studied the financial system would realize that that's a false dichotomy. I mean, Wall Street can't win without Main Street, but Main Street can't win without Wall Street. If our financial system, and in particular our commercial banking system, ever really crumped, if it ever really locked up, the economy would go into a tailspin unlike any we saw in the late 2000s and probably as bad as we saw in the 1930s.
Isn't that what adds fuel to the fire of the too big to fail argument, and therefore it justifies the government never stopping to bail out these companies?
Well, that is a very, very slippery and narrow tightrope. You're absolutely right about that. And it's maybe one of the biggest pieces of unleft or unfinished business from the Great Contraction. It is truly the case that when banks are super big, the Federal Reserve in the United States, central banks everywhere, feel that if they were to fail, it would threaten the entire payment system. So your checks wouldn't clear, your payroll wouldn't come, and so forth. And so they greatly fear that this would cause a true lockup of the economic system and virtual chaos. On the other hand, when banks understand that, they keep trying to get bigger and bigger. Just recently, there was a study suggesting that banks, even after the Great Contraction, even after Dodd-Frank, are still trying to get bigger because big banks are able to borrow a little more cheaply because the people who lend to them believe that the Fed would bail them out. And, the jury's out on that, whether Dodd-Frank or anything else that's in the works is really a remedy for too big to fail.
Isn't that a little bit optimistic to say the jury is out? Meaning, isn't the proof in the pudding that if you tell the bank, if the banks know that they always have the government to backstop them, what's really stopping them from taking, apart from cheap money that they can borrow, but from taking risks that are beyond reasonable for a bank?
Well, point taken, but keep in mind that Dodd-Frank has said they won't bail out banks. Now, simultaneous collapse of several, would they? Probably. However, an isolated bank that's too big to fail, perhaps not. Perhaps it would be allowed to fail. But Dodd-Frank proposed an awful lot of studies that are just now being done, and one expects follow-up legislation. I heard word recently about the possibility that the largest banks would have even higher capital requirements. And of course, we have the Volcker rule being proposed and perhaps being implemented, which is that banks can't trade on their own account. So I think very much bank regulations are a work in progress at this time. I wouldn't say that I'm completely confident that it's been resolved, but I think the next few years are going to be very, very interesting for people who are interested in bank regulation.
Well, interesting is certainly a good word. We are talking with Professor Mike Salemi, who is a professor of economics at the University of North Carolina. He also teaches with an organization called the Great Courses, which in fact is how I found Mike. I'm going to touch on that in a minute because I'd like to learn more about that class. But I'd like to ask you a question about something you mentioned a moment ago, which is whether banks might be forced to have higher capital requirements. Could you, A, explain what that means, and B, explain why that wouldn't be the solution to all of the problems? Because it seems to me if the banks simply had more money that was not at risk, that would make them much, much more secure.
Okay, this is going to take just a tiny bit of work, but I'll make it as simple as I can. So first of all, bank capital isn't a pile of gold coins or paper notes in the vaults of the bank. Bank capital is the difference between what the bank owns, the value of what the bank owns, and the value of what it owes. So it's assets minus liabilities. That's its capital. And a bank would love to borrow lots of money and then turn around and lend it out or use it to buy securities, because that would be a strategy which would lead to the highest possible profit for the bank. But hold on a second. If there's any kind of a downturn or any kind of an idiosyncratic piece of bad news for the bank, like a loan, one of its loans failing, then it loses that value and its capital falls. Mm-hmm. So what bank regulators do is they say, okay, you can't lend up to the maximum that your funds would allow. We're going to make you keep some of your funds in cash-like assets. Okay. Or treasury securities. And then if some bad news hits your bank, those highly liquid funds that can be converted to cash and used to pay your bills or used to pay your depositors are available to you. And so those people who think that maybe big banks should have more capital are actually saying, you want to be big? Fine, but hold some more cash, unproductive cash, as a kind of backstop against the possibility that bad news would lead you to get in trouble and then to turn to the government for a bailout.
What sort of percentage of their assets are we talking about in terms of a capital requirement?
Well, under the Basel Accords, we're talking about, depending on the size of the bank and how risky its portfolio is, single digits. And what people are proposing is not clear. It's a work in progress. I'm sure that the banks will fight against that, pointing out that they play a fundamental role in society. I mean, they take money from savers and turn it around and offer it to people who want to buy homes, buy automobiles, start businesses, and so forth. And that if you make them hold more capital, they'll have to charge more for those loans for what amounts to investment. But I think my guess is, and it's purely a guess, maybe an extra couple of percent above what the Basel Accords would call for.
It just seems to me as though the amount of money that the banks are looking to lend out, and if we compare it to different countries, can make a huge difference. For example, in Israel, the standard in Israel has always been that when you buy a house, you put 50% down and you borrow the other half from the bank. And during the crash, in Israel, we did not have people getting kicked out of their homes. Whereas in the States, I saw ads when I would come to the U.S. that said no money down, buy a house. And it seems, of course, they were exposing themselves to risk. It's so obvious. Is it only obvious in retrospect, or was it clear then?
Well, that's a great example, Doug. I think that's a super example. And in fact, I lived for a while in Switzerland, and it's very interesting there. Homes are so expensive in Switzerland that mortgages take something like 150 years typically to be retired. So essentially, your house and its mortgage passes on to another generation.
Is that really what happened?
Yeah, well, depends, right? If the house stays in your family, and it's part of your estate, so is the mortgage. If you sell, well, then everything starts over again. But the point is, people aren't expected to buy their house within their lifetime. You said 50%, and absolutely, think what you said is completely true. If people have to have that kind of equity in their home, then a 10% drop in real estate prices and home prices, 20%, big deal.
Right.
That's your own equity, right? And most people just sit tight and say, bubble pop, but things will get normal again, and we can still stay in our home.
Mm-hmm.
But before we hasten to think that's just a sensible decision, think about how long people must wait to get into a home as a result of that rule.
It's the trade-off.
When did you have 50%?
Point well taken. It just seems that with the millions of people who lost their homes, and the people who were hurt by this the most were the people who were senior citizens. In fact, I think the default rate for people over 70 grew by 8 times. Because they were buying houses that they simply couldn't afford, and the banks were. I'm not blaming the banks, by the way. I agree that every person made their own decision, but the banks were there to help when people made the wrong decision.
Well, I happen to think that there was a good bit of fraud involved in, the no income, no equity loans that were certainly offered in the United States. And
do you think that was fraud?
Absolutely.
Poor judgment?
In my opinion, that was fraud.
Okay.
I think that was fraud. I think there was a good bit of fraud. I think the criminal prosecutions are not completely exhausted. We'll see some.
Wow.
It's not central. There was a housing bubble, and it's true that Americans were tending to borrow against their homes and treat home prices as if they couldn't possibly fall, and that, of course, was a big mistake. I don't know about the fact that old folks, why would they be going into the real estate market anew unless they were buying second and third homes? But if you say it's true, I won't argue.
Okay.
But I think an awful lot of people who were home.
Yeah, I'm going to put the site for that on the show notes for the Goldstein on Gelt show.
Yeah, please.
I'll put a link there so everyone can look it up. I read an article about it just recently, and I think it's just important for people to realize, of all ages, that debt really knocks you down.
Well, but I want to say something about debt in just a second, but back to the house business here. Look, someone who was buying a home for their family and had the bad luck to buy near the time or just before the time when the bubble popped, and who were trying to just grab a little piece of the American or European dream in the form of a house that would appreciate in value and give them a stronger position in the middle class, they were truly screwed. No question about it. On the other hand, an awful lot of people, and I know some of them personally, were saying, "Hey, this is cool. I got my house, and now how about that condo over here? How about that several apartments I can lend out over there? How about, there was an awful lot of real estate speculation." And those folks in that situation, they made a risky investment and they lost. Mm-hmm. And I don't have much, I don't have any more sympathy for them than I would for anyone else who, say, bought hog bellies and guessed wrong on the price.
Mm-hmm.
Can I say something about debt?
Yes,
for a minute.
Sure.
So, one of the things a show like yours does is to try to shake up what people think they know for sure. And one thing that bothers me a lot, especially in the United States, is this constant hammering, both in the government level and also in, I think, financial talk show, that somehow debt is evil. People shouldn't incur debt. It's as if everybody suddenly was listening to Benjamin Franklin, neither a buyer nor a lender be. But hold on a second. That's just wrong. Excessive debt, yeah, but debt is a wonderful thing. Debt allows us to reach into the future of our life when we typically have larger incomes and claw some of that purchasing power into the present. So, for example, our kids can benefit. We can borrow and claw at some of our future income to help our kids go to a better school, to give them a better place to live, to give them a safer car to ride in. And none of that, no economist would say that any of that is a bad idea. It's a bad idea when you do more than your lifetime earnings justify.
Okay.
But moving money around in your life, either toward the present, which is borrowing, or toward the future, which is saving, that's just good. And we live in a wonderful time because we have a lot of tools for doing that.
Is this something that you talk about in you have one of your great courses is called Money, Banking, and Financial Markets, What Everyone Should Know. Is that a topic that you discuss there?
Yeah, it is. And I think it's a lot of fun, and it's not a new idea. There's an interwar economist named Irving Fisher, who was at Yale, who wrote a couple of wonderful books thinking about interest rates. As a matter of fact, I think he's one of the greatest thinkers about interest rates that American economics has ever known. And I've not only enjoyed reading his books, I've enjoyed explaining his ideas to my students.
That sounds great. Mike, we're just about out of time. We've been talking to Mike Salemi, who's a professor of economics. He teaches for the great courses as well. In the last few seconds, just tell me, how can people follow your work?
Well, as an academic, I've always believed in a great deal of openness, so anybody who'd want to see what I was up to could go to www.unc.edu/Salemi. And they'll see my professional webpage, and please take a look and send me an email if you have any questions about it. And if you'd like to learn more about financial markets and the current times, by all means, check out my course at the teaching company. I worked real hard on it, and I think you'd find it interesting.
Okay, and I'll put a link to that on the show notes of goldsteinongelt.com. Mike Salemi, thanks so much for your time.
Doug, thank you. This has been a lot of fun, and I very much appreciate that you asked me.
All right.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.